Joining us now, Jacob Kirkegaard, a research fellow at the Peterson Institute of International Economics. He joins us from Washington. Jacob, your reaction here as we look not only from Portugal to Spain, but now Belgium seeing some sovereign debt spread and the worrying in the bond market.
Yeah, no, I mean, what we're clearly seeing is essentially a buyer's strike, covering the entire periphery, or shall we say, covering probably, the non-German part of the European sovereign bond markets, which is clearly related to the degrees of uncertainty that we've seen emanating after after this weekend's announcement on Ireland. But I will say, though, that in the case of both Spain, Belgium, I don't regard either of these countries facing a solvency issue, which means that at some point,
right,
as these yields go up, these countries will become attractive buying propositions from traditional buyers of sovereign bonds.
But it seems right now that we're in this confidence domino effect here, because I know I've read some of your work when you were looking at pre-bailout of Ireland, what would happen there, and you were emphatic, this is a banking crisis. Well, now Ireland has a $113 billion bailout. They've got this capital cushion for their banks. They have the proverbial bazooka in their pocket, and yet the worries are still there.
Yeah, but I think a lot of these worries concerns two things. One is that the degree of political uncertainty regarding the package for Ireland, in my opinion, is quite substantial, because as I read it, even though they have gotten the bailout now, they have the list or the 4-year program that
right,
they need to implement. That program is going to have to be implemented by another government.
Right.
And that government has certainly not been very pleased with the, shall we say, the fact that there's no imposition of haircuts on senior creditors in Ireland. So the political risk in Ireland remains quite clear.
So what's the message then to European governments, though? Because you have the Irish government saying, guys, we've got to take these really tough austerity measures to get ourselves up to speed. We have to take this money even though we don't want to. We're going to take the tough medicine now, and yet the market's still asking for more. So what's the message to the Belgians? What's the message to the Spanish and the Portuguese?
Well, I think first of all, the message to these other countries is, as I would take it, is, look, don't panic, first of all, because I don't believe that Spain or Belgium, for that matter, faces a solvency crisis even at slightly more elevated yields that we're seeing now. It's clear that were they to explode up to the range that we've seen in Ireland and elsewhere, yes, they would face a solvency issue, but based on fundamentals, quite frankly, I don't think that case can be sustained.